Two things to say. Do we use the word spitballing in the UK?
You do.
It's the first one that came to mind. Spitballing. What a gross image. The other one, I don't spit anything near me, let alone those.
This is a very serious subject, we're talking about here.
Hi, and welcome to another Meaningful Money Q&A with me, Mr. Pete Matthew.
And me, Mr. Roger Weeks.
Absolutely. Nearly Christmas, Rog. Getting out all excited?
Yeah, I am. Because my house would have been straight by now.
Yes, it will. We're recording this about 4 or 5 weeks before Christmas. But
I love Christmas. And it's the time that you just get everyone together. You so rarely get the whole family together.
Yeah, that's true.
Even if you argue most of the time with them.
Yeah, I'm going to say that's I won't say that because one of my family's in here. I enjoy spending time with you, producer Kate, but sometimes it's just I like the days in between the family. As much as I enjoy the family days, it's quite nice just to have no agenda, isn't it?
Yeah, but then we've got grandchildren. So when the grandchildren come, the house is different again. Then the boys start running and screaming and jumping around, as boys do. Yeah. And the little granddaughter's very quiet. Sits down with a book. Yeah. It'll come all too soon, don't worry.
Not too soon, producer Kate, please. Okay.
But so again, if you want your questions answered, please send it to hello@meaningfulmoney.tv with a subject line podcast question, and Nick will then pull them apart and put them into our stream for us. So let's get going with today's questions.
Yeah, let's crack on. As always, remember, notes and links from today's show are at the show notes. That's meaningfulmoney.tv/QA36 for question and answer. Session number 36. That's incredible, actually. They're ramping up, aren't they? Number 50 before too long. meaningfulmoney.tv/QA36. And also, if you're watching this on YouTube, help us out. Like the video, subscribe to the channel if you're not already. It's growing quite nicely, actually. Yeah, so it's all good. Right, do you want to do question one?
The first one. Okay, this one comes from Cameron. It says, big thanks to Pete and Roger for all the excellent advice. Excellent. You're welcome. You're welcome. This question is for some of the 2.8 million UK landlords.
Which neither you nor me.
No, we're not one of those, no. But we'll try and answer it anyway. Even those with just one property in their own name, not through a limited company, are increasingly affected by fiscal drag. Looking ahead, I plan to sell down much of my property portfolio in later life because who wants to be a landlord at age 70? Plus, mortgage finance becomes trickier in your 70s. That said, even if I retain one or two of the best properties, the rental income alone may push me into the higher rate tax bracket. Good going. I'm 49 and don't currently have a SIPP, but I can invest up to £60,000 annual allowance via my limited company. Would it make sense to start building a modest pension over the next 10 years as a risk mitigation strategy? If so, how should I think about the opportunity cost? I'd save 25% corporation tax going in, but pay higher rate tax on the way out, less the 25% tax-free lump sum. So is the net tax cost around 5%? Or am I overlooking other factors like the benefit of CGT and income tax exemptions on growth within the pension? Appreciate your thoughts and keep up the great work. Regards, Cameron.
Yes.
Yes is the answer.
Cameron's answered his own question, really. I don't disagree really with anything that he said. No. When a client comes into me for a financial plan and they're like really property heavy and they don't have much in pensions and ISAs, I always sort of clench a little bit.
Yeah, it's concentration of risk, isn't it? It's all in one area there.
And properties are brilliant when they are let and, they're sort of humming along nicely. But if you have to sell one and whatever reason it's a depressed market, it's, difficult to sell, they're just illiquid, aren't they? That's always been my biggest issue with them. And they're not very tax efficient.
Yeah, if something comes along that you suddenly need to spend some money out on, you can't then sell the chimney in the front door, But with a pension, you can just dip your hand in and grab something. And if your plan ultimately, Cameron, is to start selling the properties, where's the money going to go anyway?
Well, yeah, sure.
So, if you can sell properties within the limited company, how is that money going to come out is one of the questions.
Pensions are
great. But pensions is probably one of the best ways of doing it because you've not limited by your earnings. The company can pay in up to £60,000 so long as it falls within the
wholly and exclusively for the purposes of the business. Yep. Test.
So that makes sense. And if you've got 10 years in which you're thinking this timescale, if you were to do £60,000 a year, it wouldn't be an insignificant pension plan in 10 years' time.
It's very significant. And, you can dip into them ad hoc, as you said. So if you have like 2 or 3 of the properties suddenly have blank periods of whatever reason, you can just dip in, just top up your income a little bit, maybe top up to the higher rate band or whatever. It's the flexibility of pensions these days. As soon as you get to sort of national minimum pension age, you can get at them and really sort of kind of tune how you take them to serve your particular sort of tax situation.
Well, and you've already hinted, Pete, the fact that the taxation side, the pension is far more tax efficient. It's bound to be anyway. But if you imagine you, Cameron, you sell a property and you pay a lump of tax within your company, you then invest that money in a pension plan, you're going to get that tax back in a tax-free status.
Yeah.
So, any further growth of the property you've got now will be taxable at some point in the future. Whereas if you took that money out, take a bit of hit of the tax. Nobody likes paying tax.
No, unnecessary tax, sure.
No, but sometimes better to pay the tax early and then gain that back through the investment.
It's sort of benefits now versus benefits one day as well, isn't it? Yes, you're going to pay some income tax when you take money out of the pension later on, but yes, you get the tax-free lump sum, 25%. If you're always going to be a high rate taxpayer, yes, you're going to pay 40% on the balance, but that's still what, a national rate of 30?
30, yeah.
So it's not bad.
5% difference in having the money in your own hands as well, rather than an illiquid asset.
As opposed to paying 25% corporation tax, 25% corporation tax, and then say dividend tax on top of that by getting the money in your own hands out of the company.
Yeah, and the nice thing is, if you've got to get money at the company and it's not going into a pension, how does that happen? Well, you either pay yourself a bigger salary, which you don't want to do, or you pay yourself dividends, which is taxed again. So if you've got the opportunity to start salting money away now into a pension plan, then that would be the ideal thing to do. You sell a property, a big lump of money goes into the company.
Yeah, drop it in a pension. Yeah.
And ideal way.
Sort of slight downer to this is that Cameron doesn't have a pension. Cameron, if you have any pension pot at all open for the last 3 years, you can also carry forward. So you can pay the last, this year and the previous 3 years worth in if there's cash in the company to do it.
Good call.
But it does depend on, you have to have had a pension plan
somewhere,
of some kind open, even if it's got nothing in it.
Yeah, and even if you've not paid into it.
Yeah, sure. Good question, Cameron.
Good one.
But that was actually a much more rounded answer than just yes, which is always. So this is from Joanne, presumably not my wife.
No.
That'll become clear, I imagine. Hi, Pete, Roger, and Nick. I've recently discovered your YouTube channel and podcast. It's been a real eye-opener. Thank you so much for all the great content. Thank you, Joanne. You're very welcome. I'm 45 and currently have 74,000 in a Fidelity SIPP, but it's all sitting in cash. Interesting. I know that's far from ideal, especially with 15 to 20 years until I plan to retire. I also realize it's a relatively modest pot for my age and it's not earning anything while it just sits there. How would you typically advise someone in my situation to begin investing some or all of that cash? I'm keen to make up for lost time, but I want to do so wisely. Thanks again and keep up the brilliant work. Joanne, good question.
Yeah, I'm intrigued. Have you managed to get the £74,000 in cash?
Yeah, it's
in the pension pot. Yeah, I've been contributing all this
pretty
time.
Heavily.
And actually, £74,000 for your age, Joanne, is the low end of average. You're doing well.
The low end of average.
Yeah, because if that didn't make sense at all, did it? No.
Right. Yeah, well done for being on the low end of average.
No, the average pension pot for ages is split in decades. Okay. So from 45 to 54, and you're at the bottom end. So that whole area, the average is £80,000. Well, you've already got
74.
The thick end of that, and you're at the bottom end of that age scale. Should I say it that way?
That makes more sense.
That makes more sense. You're not at the lower end of average. That doesn't make sense at all.
No. Very sorry, Joanne, if you got offended.
You're at the low end of the age scale.
Yeah. You're really young.
Yeah. And for your age, you're doing really well already.
Yeah. So, but that's a really good point. Actually, that's not a bad place to be. So you're not way behind by any stretch, which is hopefully encouraging. So. Pot in cash. Her actual question is, how would we typically advise someone in my situation to begin investing? Now, there's two ways you can do this, and one way generally makes people nervous, or can do, particularly if you're not used to investing, and that is to stick it all in. Just like buy a fund, go all in, stick all the money in day one.
Well, 50 to 20 years, that won't be a bad thing to do, but you'll only know down the line. And the other alternative that Pete is alluding to is where you drip feed it in over a period, because it's taken you a lot of years to build up £74,000. If I've not invested before, do I want to commit it on one day?
Yeah. What happens if the market drops the day after is what sort of people generally think. If you choose to drip it in, as you rightly say, Rog, there's no way to know whether that was the right thing to do except in the rearview mirror. So you'll either wish you'd have got it all in on day one, or you'll be glad you didn't. And that's entirely a toss of a coin. You can't know that beforehand. Looking back at sort of historical precedent, generally speaking, you are better off putting it all in one go. But there's so many variables there. If you drip it in, do you drip it in over a year or 3 months or whatever? Occasionally, I have sort of agreed as an advisor to drip client money in over a period of time. But if we do that, I'll say to them, it's no more than 6 months. Depends on the amounts. No more than 6 months. And we're going to do it on the first working day of the month. And I'm not going to tell you. No. So we're not going to have a discussion every month. So do you think we'll put it into today or tomorrow?
No, the worst thing you can do.
Because you'll continually second guess yourself. So that's another reason why we would generally say just get it in. Make the call, get it in, and sort of live with the consequences, because you've got 15 to 20 years.
Yeah, it's a long
this
time.
is going to outwork. So I think we would also say to invest pretty aggressively.
At this age, you would do, although I suppose if Joanne hasn't invested before, you might want to take a bit of a slower approach and perhaps invest not 100% equities, perhaps 60, 70% equities to begin with, and see how that goes.
Yeah, start there.
Really.
And
then ramp it up once you're happy with it. But don't look at it after 6 months and say, I'm not happy with it. You've got to give it its legs a bit.
Yeah, definitely.
So, I mean, I'd say good couple, 2 or 3 years before even considering changing something.
Yeah, definitely. Really. When we are talking to clients about risk, one of the things we're assessing is their experience and understanding of how investments work. Because obviously, if you are inexperienced and your understanding is therefore lower, you're more likely to err on the safe side.
Yeah.
More likely. Or some people go entirely the other way and they say, no, we're going all in. We're going to stick it all on red and hope that the wheel spins, in our favor. But obviously, that's the sort of extreme example. So if you've never invested before, we generally would say, look, we start at 60-40, so 60% equities, 40% bonds, and go up from there.
Yeah.
Unless you think you've got the guts for it and you're going at 100% equities. But with 12 years to go, you should be taking more risk than less.
Yeah, but the thing is it 12 years?
Because
actually, when you look at it, Joanne, if you're with the majority of people, you probably won't buy an annuity at that point in time. You may do, you may not. And if you don't, when you start drawing your benefits, you're going to have that money invested for another 20 or 30 years after that. So actually...
so it could actually be for another 45 years.
Another 45 years. And then suddenly it's like, well, actually, we'll go all out to 100% equities. Probably not at this point in time, but at some point you will do. But that money could be invested for the next 50 years.
Yeah, exactly.
Really. So you will give it its head, and it will do it. It'll do well, whatever you go for in the long run.
We're going to do a session. I think it's going to be the first one in the new year. I haven't written it yet, but we're going to talk about risk in detail. So it won't be a Q&A episode. I think we're going to do a sort of pretty detailed deep dive on risk and how to think about it. It's a massive subject, actually. May end up being more than one episode. When I think about writing it, there's probably a lot to deal with, but I think it's important to sort of understand it.
Yeah, and it's a lot of it's based around your experience in the past or lack of experience in the past. But you also got to allow for time scales and what's happening in the markets. The way that the markets work. People don't understand how the markets work. So it's actually, this is how they work.
I hope you don't want me to put that in the episode because I haven't got a clue how markets
No.
They
take care of themselves, but it's your thought process at the end of the day, and time scales make a heck of a difference.
Yes, they do.
But
also it's usually slightly a flawed approach to sort of think, well, that's my pension. I will do a sort of isolated risk level for this, and then a different one for my ISAs. Yeah. Far better to think holistically if you've got money in different pots. Well, actually,
if you look at the investigations into these sorts of things, the general rule of thumb is people historically in the past have, I'll de-risk as I get towards retirement. But the real trend of good thinking is actually you probably need to take more risk when you retire because you never want to run out of money. You want it to be working harder for you.
Yeah, sure.
And the worry that people talk to us about is, will I lose all my money? Well, you won't.
No.
Every company you got invested has got to go belly up, and you got more problems than that at the time. So, yeah, sure. But the number of times people say, well, can I lose all my money?
No.
So We need to talk about that in the new year.
Exactly, yeah.
You know?
Every company in the world would have to go bust, in which case I think we've got bigger issues than with our pensions. You know, whether our pensions are still there or not. Okay. We did do a video, I'm not sure exactly when, but we'll put a link to it, and it's basically how to choose funds within your pension and ISA, so that might be helpful for you, Joanne, as well. But great question.
Good one.
Question 3, Rog.
Number 3, this is from Tracy, and Tracy says, "Hi, Pete and Roger. Firstly, thanks so much for all your hard work. I devour your podcasts, books, and videos. So much hard work on your behalf, and I hope you realize how appreciated they are."
That's very kind, Tracy. Very good. Thank you.
"I'm just at the stage of life where in the next few years, I need to start thinking about drawing money out of mine and my husband's pensions, and I'm considering the most tax-efficient way of doing this. I've been reading all about UFPLS and FAD, Flexible Access Drawdown. As background, it is unlikely that either my husband or I will ever have much personal allowance unused in the years up to receiving our state pensions due to rental income we receive.
Okay.
It is also unlikely that either of us will ever become high-rate taxpayers. I also understand that to get the most out of one's PCLS, pension commencement lump sum, it is best to only crystallise the funds actually needed from an uncrystallised pension so the rest of the pot can hopefully grow and therefore the 25% tax-free sum that's left also grows."
Yep. Fine so far.
Yep. Understand all that so far. So my question is, what am I missing? In what situations would it be more beneficial to take an UFPLS payment versus making a partial crystallisation into a FAD pot? I'm with II, Interactive Investor.
So why did that take you so long?
Yeah, no, I don't know. Because I don't look at my Interactive Investor pension very often.
Okay.
Hint for listeners there who offer this. "I feel like an UFPLS payment would give me 25% tax-free and 75% taxed right away, whilst a FAD would give me the same 25% tax-free and 75% could be taken straight away or drawn down over time as desired and could also be left invested to hopefully grow. Thanks so much, Tracy."
Yeah.
Yeah, you're right.
Yeah, it's another one. It's like, excuse me, you know, we're very lucky in that our listeners really do get it.
They do.
So the questions usually are quite nuanced. And I don't think Tracy's missing anything. My question is, what am I missing? In what situations would it be more beneficial to take an off-plus payment versus making a partial crystallization? Well, I think, you know, if it's about topping up income, off-plus is probably the way to go, isn't it? Because you would, you have a quarter of the payment is tax-free, the other 3/4 is taxable. You're not going to be high-rate taxpayer, so you're only, in inverted commas, going to pay 20% on it. Whereas if you decided you needed to take 50,000 quid out, like a big chunk, then obviously that almost certainly would take you into the high-rate tax band. So that would be when I would be thinking, well, actually, let's take that as tax-free cash.
Yeah, and
probably.
And I think what Tracy doesn't say here is how much the pension plans are. So we don't know the level of the tax-free cash that's available through them.
That's true.
So, yeah, I mean, it depends on the tax you want to pay. Is it better to pay the tax now or pay the tax later on? So if you're dead against paying tax, then you draw as much as you can tax-free.
Yeah.
But the F+ will give you the income whether you want it or not because you've gone for the F+. It'll give you the whole 100% payment, of which 75% is taxable. So that's the deciding factor is, what do I want this money to do for me?
Probably fiscal drag's another factor, although that's not something we can control. So because if, income tax bands stay where they are, and, let's say Tracy and her husband's like rental income goes up and, when they have state pensions and stuff like that, they will increase by inflation as well. If the thresholds stay where they are for too much longer, we'll see. We're recording this a week before the budget. Won't be surprised if there's an extension to the freezes on the
I imagine there are going to be,
Then, potentially they could become higher rate taxpayers by virtue of fiscal drag, in which case that would be a factor in the decision. Not yet, maybe, but it might be if they get closer to the higher rate threshold going forward. But other than that, like you say, tax now versus tax one day, if you at least what rate it's going to be at now.
Yes. But if you know you wanted an extra £10,000 worth of income, you say, okay, what I'll do is I'll draw something like £12,000 or £13,000. The first 3 or 4 is tax free, the rest is taxable, and I got my 10 grand. That's top my income up, part of which is tax free. Yeah. So although it's a 20% tax rate, you're actually only paying 15% tax on the whole withdrawal.
Yeah.
So
F+ is great, really.
F+ is a great way of doing that.
Remember when it came out? We were like, why would anybody do that? And now it's almost the first choice for a lot of people.
It's one of those things that why do they invent that? It's like flexible access drawdown, but you take it in one go. It's like, well,
Yeah, what's the point of that? But actually, this is the point. It's exactly right. It was made for you, Tracy, and people like you. So I don't really know there's anything to add to that. You're dead right. Anything that's uncrystallized and can, continues to grow, that increases your your latent sort of tax-free cash in there. If you've got a 100,000 uncrystallized, your tax-free cash on that potential tax-free cash is 25,000. But if it grows to 200,000, then your tax-free cash is 50 grand now, isn't it? Yeah. So, and even your crystallized funds are still invested. They're still growing.
Yeah.
So even though they're going to be taxable down the line when you draw them and on death, if you die after April 27, I think she's got it. I don't think there's anything else we need to add, really.
No, and because you're leaving the fund in the pot, yes, you pay tax on the far end, but you're paying tax on some of the growth. So actually, the effective tax you're paying on your money is less.
Yeah.
If that makes sense.
Yeah.
I think so.
That's the contrived silver lining, but it's true. It's true, though, isn't it?
It is.
It's not all, and particularly, obviously, we say that as well about like employer contributions. But yes, it might be taxable, but you're being taxed on money you never put in.
Yeah.
As well as the growth. So, yeah. Good. A bit of a frog in my throat this evening. It's a bit annoying. I've got water, but it doesn't seem to be doing anything. So, apologies if I do cough and splutter a little bit. I'll try and avoid that and keep it to a minimum. Right. Here's question 4 from Jamie. Hi, Pete and Roger. Thanks for hosting such a great podcast. People have been very kind this evening.
They really are.
And they always are, in fairness. I've recently been searching for a new job and was lucky enough to receive an offer with some interesting compensation features that I thought I would ask your opinions on. I mean, this is probably about 5 months ago this question came in. So, Jamie, I hope you haven't made a really rash decision while you've been waiting for us. I actually turned down this role in favor of something else, but I wanted to ask nonetheless. So good. As the offer came with an interesting feature that I have not come across before. Firstly, and probably most straightforward to answer, the salary on offer was £50,500 per year, which seems a weird figure. Suspiciously, only slightly above the threshold to tip me into the higher rate tax bracket, which got me thinking, are there any benefits to the employer or employee of being only just into the next tax bracket up? Why not 50,000 or 51,000?
Yeah. Just because I'm paranoid doesn't mean they're not following me.
Yeah, we'll answer that in a minute. Secondly, in addition to a very generous DC pension scheme, they would pay in 12% if I pay in 5%. Ooh, that's really good. Generous.
Really good.
I hope the job you took was better. They offer a savings scheme whereby 5% of my salary would be deducted and paid into this scheme each month. And at the end of 12 months, the company would then top up these savings with another 5% of my annual salary. Actually 6% to, quote, account for the extra tax. My real question is this. What are these savings schemes in a nutshell? And are there any benefits of them over trying to negotiate for an increased employer pension contributions instead? Interested to hear your thoughts on these. Thanks so much, Jamie.
I was interested too, because I'd never heard of them.
I mean, we don't claim to be the oracles, right? But I mean, we'd heard of most things.
Yeah.
I'd never come across this.
No, so I had to open the nutshell on this one and see what was inside.
Yeah.
Take your first question first, which is the best way of doing it, I think.
Well, usually.
I don't think you need to read anything into this 50,500. It just happens to be the going rate for that job, I guess. That's that level of job that you've got. There's no benefit in the employer.
But the employer pay a little bit of higher. No, it's not. It's the same rate now.
The same rate now, isn't it? 15% of the
15%. National insurance over that. It used to be a lower amount, above 52.70.
Yeah. I think it was just the going rate for the job.
Yeah,
there's no reason they would tweak you over the top or keep you below, really. It makes you think about it and say, well, actually, if I'm tripped into high rate tax, what do I do to get myself back down again?
Back down, yeah.
Which is
salary sacrifice and things like that. But this payroll savings scheme, it sounds like a pension, but it's not.
No.
It's literally it's a way of kind of helping people pay themselves first, something we talk about all the time. We talk about, when you get your salary, on payday or the day after, send direct debits into savings and pensions and ISAs and all that sort of stuff so that you never really have that money.
Yeah.
Well, this is very definitely, it's saved for you and is drawn from your payslip, essentially.
Yeah. So you pay your tax and national insurance like you'd normally do.
Yeah.
And the deduction comes and it goes into a savings account. So it doesn't even hit your bank account, which is good to encourage savings.
Yeah, brilliant.
Because there's so many people that don't have much savings at all. And it's saying, look, let's help you do that by paying yourself first.
Yeah. We'll put an article in the show notes. Nick, was it Nick or was it you?
No, it's Nick.
It was Nick found an article, the business case for payroll savings, and it's just some of the sort of benefits, both in well-being and sort of good feelings towards the employer and that sort of stuff, by employers providing these things, were really quite profound. What really messed me up and messed us up, when we were sort of not arguing, but sort of talking about this beforehand, is this addition by the employer at the end of the year.
Yeah.
And the fact that Jamie says, they will top up the savings with another 5% of my annual salary, actually 6%, to, quote, account for the extra tax. Now, there is no way, if this is not a pension, that Jamie wouldn't be taxed on that.
No.
Because that's a benefit in kind, or an additional...
It's like a bonus.
Yeah,
it's like an annual bonus. So effectively what's happening, Jamie, is that you're getting given a bonus, but they're not going to pay it to you direct. They're going to shove it into your savings account. But because they know that bonus will be taxable on you at hopefully 20%, then they've got to actually put the bonus at 6%, because in your salary, you'll pay an extra bit of tax on that bonus. Heaven forbid you're a high rate taxpayer, because they'll be giving an extra 20%, but you'll be taxed at 40%. But, you will find a way of doing that. But there's no liability, no compulsion for the employer to pay in at all. So actually, they're doing you a really good favor.
Yeah. But you would pay tax and NI.
But you would pay tax and NI on the extra, and actually
so
they would pay tax and NI.
They pay national insurance on it as well, so they would pay 15% on whatever they put in.
Yeah,
employers NI.
But actually, the benefit when you look at this report that's been done, it makes employees feel so much more comfortable because they've got some savings behind them. As a result of that, then they look at the employer in a far greater light. I suppose the only thing that I thought of when we're spitballing this before we came online is to say, if you are the sort of person, Jamie, that's already got savings behind you and you don't need to be encouraged to save because you're that sort of person, and if you're listening to the podcast, you're obviously doing all the right things already.
Yes, all the right things.
All the right things already. Then actually your throwaway comment about negotiating an increased pension contribution might be the better way to go.
Yes.
Because you're not going to pay tax on it.
No.
Your employer's not going to pay national insurance on the actual contribution for you. And from then on, it grows tax-free, whereas your workplace savings will be subject to taxation depending on the interest rate return you're going to get on it.
Two things to say. Do we use the word spitballing in the UK?
You do. It's the first one that came to mind.
Spitballing. What a gross image. The other one, I don't spit anything near me, let alone those.
This is a very serious subject, we're talking about here.
Just some of these stats. So companies implementing payroll savings see 22% reduction in employee financial stress and 17% decrease in absenteeism.
Amazingly.
That's incredible. Companies offering these programs experienced 12% improvement in employee retention rates. So you stack that up, it's worth the company putting 5% in.
And there is something in that report, or another one I read about it, saying that when you're recruiting people, you ought to put it in as a benefit, not necessarily that they're going to pay in themselves, but we encourage you to save, and we'll help you do it. And there's two versions of this. Is like auto enrollment. You either opt in and say, actually, I want one of these things, please, or actually they can set up where you have to opt out. So we'll take 5% of your salary, put it in a savings account, unless you opt out.
Yeah, and you can get it any time, I think. But if you leave it in for the 12 months, obviously.
You get a bonus.
Potential employer got this bonus. 82% of payroll savers continue their saving habit even after changing employers, which demonstrates its effectiveness in building lasting financial behaviours. I think it's a brilliant
It's a really good idea. Really good idea.
Sounds like something we should put in place at Jackson's, really. Really good. I think it's just brilliant. I'd never heard of it.
No.
So thanks. Every day's a school day, Jamie. Thank you for that. I hope that your new-ish job by now is going really well and that they offer one of these too. Question 5, Roger.
Question 5. This is from Danny. Danny says, hello, Peter and Roger. I recently found your podcast and wanted to say thanks for all the insight you are providing. Not only do you make a fairly dull subject tolerable, that's fine, you even managed to make it reasonably enjoyable.
There's a little winky face emoji because like reasonably enjoyable is kind of damned by faint praise, isn't it? It's like, well, it's all right. It's reasonably enjoyable.
Well, now you can see us as well. You might be enjoying it more.
Maybe.
Possibly.
It's a little bit weird, but it's fine. No, carry on.
My wife and I have a couple of rental properties which should be paid off along with the house in a year or so.
Wow.
I'm 47 and on an average salary. I have a medical condition, which means I'll probably be unable to carry on working until 67, but life expectancy is unaffected. That's good to hear. Mm-hmm. The problem I have is I don't know when I'll need to access my personal pension, so planning is a bit tricky. My DC pension pot is just over £200,000, which ordinarily would be quite healthy, but if I have to access it at 57 suddenly, it isn't so great. I'm currently invested 100% in shares, and I've been a bit braver than I'd normally be inclined, as I feel I need to make hay while the sun shines. But now getting to the stage where I might want to reduce the risk on the money I've worked hard to save. The problem I have is knowing how to go about planning for an uncertain future. I'm also aware I have a blind spot when it comes to bonds. I know they are meant to fare better than shares in falling markets, but not sure if the reality matches the reputation. You're right there.
Yeah.
Fundamentally, I just don't understand the mechanics of how they work and what factors affect how they move. Would be very grateful to hear your thoughts. Thank you, and keep up the good work, Danny.
Thank you, Danny. Okay.
I suppose the difficulty really is to say that we've all got an uncertain future. Yours is perhaps a little bit more uncertain because of your health conditions. But the problem we have with everyone is uncertainty of life expectancy, of how much you want to spend in the future.
Yeah.
What might befall anybody between now and drawing their pension.
That's right. Yeah. We can only plan assuming that all will be well. But I think, for you, Danny, you can't access it before 57 anyway, but I think I will be planning that will happen. If you think that's likely because you're not going to be able to work sort of longer, then you've got to plan, say, okay, I'm going to need to access my pension at 57. Yes. So knowing that, what else do I need to sort out? We've got to say, that's very impressive that at 47, you'll have, in a couple of years, you'll have paid off your home mortgage and two rental properties. So that's good going.
But actually, that plays in your favour then as well, because if that money's going to stop going out of your account, you could actually supplement some of your pension planning by saving up into cash ISAs, stocks and shares ISAs.
Oh, once the mortgages are paid off.
Once the mortgages are paid off,
redirect.
You redirect some of the money, so you're building up a cash fund behind you. So it's not necessarily all pension.
Yeah, well, yeah, exactly. But I mean, pensions obviously you offset some of the tax on the income, like the rental.
Yeah, you can
stuff,
do. Yeah,
so that's good. So I mean, I think that's all you can do, really. We generally would say beware of reducing risk too early, because 57 is it's not a cliff edge; it's just a threshold. It's a sort of transition point, really, from pre to access to post. Starting to access your pensions. Chances are you'll be invested for 30 years after that. So don't sort of think of it. You may have heard us talk about cash flow ladders here. That's what we would be doing if we were planning for a client. Rather than just say, well, I need to reduce the risk of my pension because I'm approaching 57. Yeah. We need to think, okay, how much do I need to access at 57? And as you get there, start thinking about laddering. So cash for near-term money, and then, quite aggressive investment for money that you're not going to spend for at least sort of 10 years or so. Yeah.
I think the nice thing as well is what you already say, Dan, is that you've actually got rental properties behind you as well. So the mortgages will stop on those. So immediately your income will go up.
Yeah.
So you've got that to help live upon rather than have to use it to fund mortgages in the meantime.
Yeah. So Danny feels like he has a blind spot when it comes to bonds. I think most people understand bonds far less than they do equities.
Because they're built differently.
They're an entirely different animal.
Yeah.
There's something like 3 times as many bonds traded in the world as there are shares in any given day.
And it's one of those things is I understand them because I'm in the business of doing it. But I don't think you need to hang yourself up too much of not understanding them. I mean, if ultimately you're going to start building your cash flow ladder at some point in the future, or if you want to de-risk some of your portfolio, which we sort of temper against for you, is bonds will probably form part of an investment you might have. So instead of having 100% equities, you might go for 80-20. Well, the 20% in bonds, you haven't got to worry about that. Somebody else has to worry about that.
Is which bonds to buy. Yeah,
yes.
For sure.
So unless you're buying individual bonds yourself,
most people don't.
Then I don't think you need to hang yourself up too much on that and say, well, I don't really understand them.
No, I think we're definitely going to do a session on bonds. I think we might mention that earlier. That'll probably be in February now because we've actually planned up until the end of January. Here we are recording this in the middle of November and we've got planned content at the end of January.
My life is planned before me.
It is. And mine too. So we'll do a dedicated session on bonds before too long. It's too simplistic to say that bonds fare better than equities in down markets. I totally understand what you're saying there, Danny. Obviously, it depends on the market. We've seen markets where everything's going down.
Yes.
Right. And A bond is a totally different kind of asset. Its price, or the factors that determine its price, are kind of many and varied. When it comes to equities, with shares, it's like, okay, if a share is popular, right? If sentiment is in favor of a share, maybe because the company's being managed really well, the outlook for its market is very positive, so chances are profit's going to go up. More people want to buy the shares, the price goes up, and then vice versa on that. And that's still the case with bonds, right? But with bonds, we're not talking about how well a company is doing or how well its market is looking. There are other factors like how long the bond will last. A bond is simply an IOU. So when does the bond end? What's the term? What is the yield on the bond? So what is the interest rate being paid on the debt? What is the quality of the company or government that has issued the bond? So they are a more complex beast. So we will talk about all this. I think as far as we need right now, what we need to say is that they're just different.
Yes.
They're generally less volatile, but it's a huge generalization because there's a range. You can get bonds which behave very similarly to equities because they're higher risk sort of versions, high yield very often called. They're generally less volatile. So that's why we tend to water down equities. It's sort of like a dilution.
It is, yes. So
100% equities is the sort of, full tequila shot. And then, sort of 60-40 or whatever is this sort of, people have whiskey and water, don't they? You don't.
Yeah, I don't, but people do have whiskey and water.
Real man, Rog. Do you know what I mean? So it is a sort of watering down. And that's why it's very simple. And bonds are easy to buy in funds like shares. Yes. And as you say, you can get one fund with both shares and bonds.
Exactly. And I liken it in a way. The reason you'd have bonds within a fund is like putting a stabilizer in a ship. If in the North Sea, the ship will bob around a lot. If it's 100% equities, you put a stabilizer in it just makes the variation slightly lower. But that's a big generalization, but they do tend to slightly reduce the volatility. Yes, but then again, you say gold is a safe place, but gold price varies all the time. So
that's a different question again.
That's another question.
Let's not get into that now. No. Let's get into question 6 instead. This is from Tom. Hi, Pete and Roger. I'm 31 and have been listening to this podcast for at least 10 years.
From 21?
I know. Wow. So I've been very lucky to have baked all your wisdom and advice into my own financial habits over the formative years of attending university and entering the world of work, which has undoubtedly set me on the right path for the rest of my life, I hope. I can't thank you enough for your generosity and dedication to this mission.
That's massively impressive.
Oh, amazing. My question is maybe an unusual one. I am fortunate to be in a well-paid job in what I think is a relatively secure career, and I have all of the basics covered. A good emergency fund, no debt, money put into wealth-building mechanisms, pensions, stocks and shares ISA. I have more than enough to be comfortable. Unfortunately, a couple of years ago, my brother got diagnosed with a rare cancer at the age of 26 and has been battling the condition ever since. He spent a lot of time in the care of the national treasure that is the Christie in Manchester, and I'm so grateful for the work they have done to support him and would like to financially donate to them so that I can do what I can to help them and others in return. I get what I consider to be a significant pre-tax annual bonus to the tune of 10 to 15,000, and I'm considering donating this in a one-off charity contributions through my employer's benefit scheme each year when I receive it. Alternatively, I could pension dump these bonuses and build a strong compounding engine for retirement one day, and at that point could then donate a substantially higher figure, potentially even just from interest on the core portfolio alone. Whilst I won't ask you to answer what is probably an impossible question on behalf of the Christie in terms of which is more important, money now or money later, do you have any thoughts on the pros and cons of either approach? Is there a right answer here in your opinion? Thanks again for all you do, Tom. Brilliant question.
Really good question. And a terrible situation you've had to go through.
Yeah.
But it brings forward a very important matter about potentially gifting to charity and gifting out of your money, because you've got the wherewithal to be able to do that. And there's so much joy in gifting.
There really is.
When you can do it. So.
I'm not convinced pros and cons is the right way to answer this. It's not going to be. It's certainly not a binary question. No. I would have thought that Christie would rather have the money now, wouldn't you?
I would have thought so, because we know that charities are having difficulties getting money these days, and if you're pleased with the work they have been doing currently or just recently with your brother, it would make sense for money to be helping those people that need it now, in my book, really, because there could be more versions of your brother needing help from the Christie, and it all costs a lot of money. So I think there's merit rather than saying, which is best. I think there's merit in saying the Christie could probably do with the money now, and other charities are available, but this one is close to your heart. So I would say, and it's close to your heart, it will make you feel so much better to be able to do that now.
Yes.
And you can also give in the future because you'll still be funding your pension.
Yeah, for sure. This is not a binary thing. I mean, it's a sort of, obviously, this is very current with everything that your brother's going through. So, doing something about that now, contributing towards the work of the Christie, I'm sure will make you feel better now. But something about giving is that it's quite addictive. And you tend to find once that people do start giving in earnest and intentionally, that they tend to continue and generally increase. And so this might just be kind of like a watershed moment for you, Tom. And you continue giving, maybe, more in great years, maybe a bit less in leaner years or whatever. But generally speaking, you will become a considerate and a consistent giver. Your own needs are going to be met. I mean, if you're in this position at 31, you've cracked it financially.
Fantastic, really.
Keep doing what you're doing for the foreseeable, and your future needs are well in hand.
And of course, if it's a registered charity, which clearly your Christie is, you can gift aid.
Yep. So
you'll get an uplift of your contribution anyway by tax.
Yep.
But it's a great thing for you to think to do, and you can only do that because of what they have given your brother. So giving something back like that is really will raise your shoulders. It really will.
Absolutely. Yeah, this was just a great question to receive and read, because it's obviously it's been some pretty dark times for you and your brother and the family. But once our own needs are met, remember there's only 3 uses of money. You spend it now, you invest it so you can spend it later, and you give it away. And of those, by far the most joyous is giving. And I think you'll get a taste for that. So, I want to say just do it now, Tom. I think you'll feel better, and the Christie would rather have it now. And
it just shows you there are things more important than money, but if you can use money to help those other things,
then great.
It's really, really good.
Good stuff.
Yeah,
great
really good. Yeah, some really good questions tonight, actually. And hope the answers were helpful. We say that every week. Nobody ever comes back and said they weren't helpful, do they? But do
they come back and say that they were? Yes, they do.
They do. They say they're appreciated.
They appreciate the time and effort. The actual answer was no use at all, but thanks for trying.
But you may think of a question I can't be bothered at because somebody else would have already sent that one in, but no. They probably haven't, but just shove them in and see what happens. So please keep them coming at hello@meaningfulmoney.tv, and we'll put them in future episodes for you.
We will, but that's it for this week. Hope you enjoyed it. Links and all the stuff we've talked about, go to the show notes at meaningfulmoney.tv/QA36. We'll put links under the video as well. And if you're watching this on YouTube, like and subscribe to the channel if you're not already. It really helps and makes the algorithm benign to our cause. So we're glad for that. But I hope you enjoyed it. Thank you so much for listening and watching. Thank you, Mr. Roger Weeks.
You're welcome, Pete.
We'll talk to you next time.